Good afternoon, everyone. It is my distinct honor and pleasure to act as moderator for this panel on essentially a subject matter that I've dedicated the last decade of my career to. I am here with a very esteemed panel, as you can see, who I'll introduce in a minute. And over the next 45 minutes, we will be discussing, well, in summary, initially, the current landscape of the sustainable bond market, and essentially trying to explore where this market's going, what is to come. So I mentioned that this is a subject matter that I'm incredibly passionate about. Indeed, the first billion-dollar green bond was issued by my team almost 10 years ago. And I remember the Economist highlighted that trade as a landmark that opened the market. At the end of the year, in fact, 2013, there was $11.5 billion of then only green bonds, which were the only sustainable bonds of scale at the time. So I'm sure you'll agree with me that it's quite incredible to think about it, is thinking about the market over that time, almost 10 years, and we're at a point where we have now seen $2.5 trillion of sustainable bond issuance. So the market continues to grow, as Verena alluded to, and the share to date, we've seen about $350 billion issued, which does sound impressive. However, it is down about 22% year on year. And there are various reasons why this is the case, some of which you're well aware of. Of course, we have the Ukraine crisis, in addition to, of course, inflationary measures, the monetary policy tightening, etc. Nevertheless, market expectation is that sustainable bonds will at the very least, meet last year's record of $1 trillion in issuance by year end. We've also seen very recently a flurry of sovereign issuance in this space, not least, of course, our host country, Austria's inaugural green bond of late. We also saw the France sovereign's first inflation-linked green bond. So it continues to be a market that's innovating and welcoming of new issuers, also in the corporate space, where we've recently seen Volvo and the likes of Huhtamäki, the sustainable food packaging company. And with me to discuss where this market is going, as I said, is my esteemed panel, beginning in alphabetical order, of course, with friends and family, shall I say, with Julie Becker, who is the Chief Executive Officer of the Luxembourg Stock Exchange. We also have Niall Bohan, who is the Director, Asset and Financial Risk Management in the Directorate-General for the EU budget at the European Commission. We have with us a former colleague of mine, Andrew Cross, who is the Chief Financial Officer at the Asian Infrastructure Investment Bank. Jerome Haegeli, who is the Chief Group Economist at Swiss Re. Nicholas Pfaff, who many of you know, of course, as the Deputy Chief Executive Officer at ICMA, and of course, the head of the Sustainable Finance Department at ICMA. And last but certainly not least, the formidable Andrew Steele, who is the Global Head of Sustainable Finance at Sustainable Fitch. So perhaps I'll start off with you, Andrew Steele, that is. If you don't mind, could you share, given your role, what do you see as the view of the current state of the market?
I think we've heard quite a lot of commentary about that during the day so far, but I mean, it's clearly one of rapid growth. There's a lot of innovation going on, and we're also seeing, I think, what will be described as increased, if not full integration of ESG into investor workflows. And that's something which, has been going on for a while, but we see accelerating and becoming very firmly embedded overall.
Yes, the integration being the main theme you're saying as an expansion of that. Nicholas, would you like to add to that?
Yeah, I sort of revisit these numbers on issuance. I think that although in relative terms, the numbers seem to show that issuance is down a bit less in sustainable bonds vis-a-vis the rest of the market, I think nonetheless, we have to acknowledge that it's no longer a question of the market increasing by 50% every year. I think we had an extraordinary year in 2021. The geopolitics have changed, the world has changed. So I think, the question this year is, will we do as well as last year, or will we be down a bit? And then the other interesting point, I think, is what's going to be the composition of issuance this year. Last year we saw social bonds emerge in a dramatic manner, particularly with the European Commission, but also with other agencies and SSAs more broadly transforming that market. And then there's the question of what's happening with the new market, sustainability-linked bonds. That's really picking up. It picked up a lot last year. Are we going to see the same kind of momentum? So there's the thoughts that come to me.
Yeah, the social bonds, of course, came to shine, particularly during the pandemic, and the new kid on the block, which is the sustainability-linked bonds, certainly we continue to see growth there. Jerome, you come from a different industry here, of course, in terms of representing the insurance industry. Have you a view as to where the market currently is?
With respect to my view where the market is, and also taking the investor's perspective, and we have heard it before, I think the reality is market is still growing. That's the good thing, and it's positive. You have come a long way, but growth is coming down. And if I look at a good year for sustainable bonds, if I look at 21, for example, sustainable bonds reached more than 1 trillion in terms of issuance, and that's in an overall environment where you had global bond issuance of around 9 trillion. So in a good year, you had 10% of sustainable bond issuance, meaning 90% wasn't. And now growth is coming down. And the main point I want to make is we need to do much more. I think there's not yet the moment to say we are in a green financing crisis, but it's clear if you want to achieve the goals, and it's easy to do pledges, but track the flows, track the financing, and if you add up the financing, it's just way too little where we are. We won't be able to manage greening the economy 2050 if we stay on the course we are today in terms of the finance. Much more is needed. Maybe an additional point I wanted to add from what Nick just mentioned. I think yes, on the instrument side, very exciting developments. I think in Europe, we would also be very well advised to look also outside of Europe. For example, in Japan, economic transition bonds, and also looking at how difficult the economic environment is, how much uncertain it is, how much inflation we have in the system, which will prove difficult to calm down. I think it's a regime shift. Looking ahead, we have to think about ESG as one menu and not separate the S and the G from the E. That's the only way, in my view, that we can achieve the financing goal of greening the economy. We need to be able to get the financing. We need to be socially also adjustable. So much more is needed. And in that sense, from an investor's perspective, I think we need to lower the barriers to channel investment flows into greening the economy. Thank you.
It's interesting giving the inflection point, because we are sort of half midpoint to the SDG goal this eve that we will talk about at the end of the panel. Andrew, what are you seeing from your seat?
Thank you for the question, and thank you to the sponsors. I had a really lovely lunch, so I wanted to say thank you very much to them for paying for it, which is hopefully a charming way of saying these things don't happen unless somebody cuts the check to put us all in the room. Denise knows I worked on the first IFC bond that followed the first World Bank bond back in 2008, 2009. Yeah. And I see old friends in the room from EIB, and I know there's always a debate about who did the first green bond, but I don't think it really matters, right? I mean, it's just great that we've got them. But my perspective on bonds sort of goes back that starting point. And I remember going out to see investors and trying to sell this massive $200 million green bond. It was just really difficult. Investors didn't want to buy it. They didn't understand it. They weren't quite sure about this ring proceeds. They weren't quite sure about this separate body. It was Cicero at the time that was doing it. That was the go-to organization. Did you have the processes in place? And by the way, we would like a premium to the bond as an investor to take it, because it doesn't fit our fiduciary duty to give it at the same level or a reduced price. So it's fantastic to see how this debate has sort of moved on. It's 2022. And AIB basically now does what I thought we should be trying to do as an institution back when I was at the IFC, which is if everything you do is around the environment, about prosperity, about essentially making the planet a better place, that's a fairly good intent way of talking to investors about your underlying investments. I'm a pretty simple Kiwi, so my bank's name really helps me remind me every day what's my asset class and where do I do it. And I sit on the investment committee, so I see every project that comes through, and I know the first policy that the bank put in place in 2016 was the environmental and social framework, which is in every single investment. So I'm a big believer in that if what you're doing makes sense with what you're saying to the market, and you can grow it and you can contribute it, then this is just a natural growth. And the other thing, if I may, Denise, isn't it fantastic that the founders, maybe inadvertently when they were thinking about green bonds, didn't really go, this is the tight standard that a green bond should be. They sort of went, let's build a big tent, let's get loads of people in it, let's generate lots of enthusiasm and momentum, and that's one of the ingredients where we are now. Yeah, I know we can all have a long debate and polish the problem about standards, but I think it's just a phenomenal journey. I'll stop, thank you.
It has been a phenomenal journey, you're certainly right. Niall, what is your take on where the market is?
Okay, I approach the question from the perspective of the manager of the world's largest social bond program and what we hope will become the world's largest green bond program under the Next Generation EU, where we launched or issued last year, printed 12 billion euros in our inaugural green bond. So indeed the market has come on a distance. And our experience with this is that there's just a massive inherent power in connecting finance to value-driven investments. Investors want to vote with their feet. They want to put their money behind the most pressing challenges of our time. And we, as the European Commission, have built our issuance program on the back of that value-driven commitment and demand by investors. We've, in the past 18 months, issued 220 billion euros coming from nowhere to 500 million in 2019. Of that, 95 has been social bond and 25 has been the new green bond issuance program. In building that program, what we see, what experiences we take, massive oversubscription for all EU bonds, but particularly the green bonds to the tune of 12 times oversubscription on the syndicated deals. And a greenium, it's definitely there. We see it 2 to 3 basis points on issuance day, and then in the aftermarket, it widens further for investors to 4 basis points. And these are not experiences that are unique to the Commission. We see them across the wider market as documented by the Climate Bond Initiative study. So yes, things are difficult this year, or we see less momentum in the market. We were expecting a year-on-year doubling. That is not materializing this year in very difficult market conditions. We're all aware of that, but we still see this upward trajectory in green. And just to conclude, the Commission and many of our sovereign peers and their agencies are very, very committed to funding the transition and the climate challenge. It's baked into EU policy. We will be funding the recovery plan to the order of 250 billion via green bond issuance. And now we have the energy diversification challenge facing Europe, part of which will also entail investment in renewables as part of the response to this new acute challenge that Europe faces. So that, yes, maybe there's a bump in the road here, but the direction of travel is very, very clear, and the Commission will be leading from the front.
Well, I think the transition is certainly a big part of whatever the future of sustainable finance is. Julie, now you are, of course, underpinning the market, given the role that you play. What have you seen and how do you see the market right now?
Well, in addition to everything that has been said so far, I think, well, 2022 has been quite difficult so far for financial markets, of course. The economic recovery from the pandemic has been derailed, of course, by the geopolitical concerns. And as you said in your introduction, the level of global green social sustainability debt issuances has decreased by around 20%. However, what we observed on the green exchange is that in terms of number of issuances, it has been quite stable, meaning that the issuances are now issued in considerably smaller amounts, but the number of issuances at the end remain exactly the same. Another trend, I think, or element which is linked, of course, to the current state of the market is regulation. It has been very well underlined just before our panel, but I think this is very, very important development for the market, and not only for the green bond market based on the EU taxonomy and the EU green bond standard, which is hopefully expected to have positive impact in the development of the green bond market, depending, of course, of its features at the end, but also the sustainable finance disclosure regulation, which would also impact very positively the fund industry and encourage sustainable investment. And lastly, I'd like also to underline something that has not been shared so far, and maybe the more recent development linked to greenwashing claims leading to fines, which means that greenwashing has consequences, and that of course can reinforce the integrity of the market.
Very, very interesting and very crucial point there. I want to stay with this point in terms of the growth of the market and what you've seen. I mean, you've been pioneering, of course, with the LGX's creation of the green segment. How would you say that the role of the stock exchange has furthered sustainable finance beyond labeled green, social, and sustainability linked bonds?
Well, so the Luxembourg Green Exchange, which has been established now 5 years ago, with the mission to contribute to the sustainable development goals and really to reorient capital flows to sustainable development projects, is mainly focused on transparency and bringing clarity and integrity to the market. So we have exponentially grown, both in terms of products of reach and impact. In terms of products, we went beyond. First, we started with green bonds, 2016. 2017, we expanded the platform to social and sustainability bonds, and 2020 to sustainability linked bonds. So following also ICMA guidelines and guidance and principles. We have also expanded the platform to funds in 2017 and completely revamped this window based on the current regulation to reflect Article 8 and Article 9, and enhance the visibility of ESG funds and impact funds. And we also added in 2021 a new window for climate-aligned issuers, because we consider that bonds being issued by those issuers are sustainable investment opportunities also for the investor community, as they are issued by companies deriving at least 75% of their revenue from environmentally friendly activities.
I think that might make Andrew very happy to hear, actually. You know, I think a lot of the work that has been done with, you know, the principles has trickled down into other asset classes, and you see, you know, emanations of that within the loan space, repos now, securitization, etc. And Nicholas, in general, would you, I mean, your view, obviously given the role that you play on the ExCom and the Secretariat, can you shed some light on other emerging sustainable finance trends beyond green, social, and sustainability linked bonds?
Okay, I can try, but the first thing I'd like to do is, as you heard, that in addition to Denise's work, IFC, she's been the chair of the GBP Executive Committee, and I'd like to acknowledge the great work and leadership you've been doing in that role. Staying on the theme of what we're doing first with the green bond principles, and anticipating on our event, which is going to be on June 28th in London, hosted by the EBRD. We're firstly going to be, and echoing what Denise is saying, expanding our advice to other segments and to other products. We've had a really interesting dialogue with other key constituencies within ICMA on the repo and the commercial paper side, so we can see some joint guidance coming out of there. During this year, it's not going to be immediate, but we're going to give an update on that. Very specifically, we're also going to update the GBP in relation to securitization. That's a big topic, which has come up earlier. And we're also going to provide some additional guidance for SLBs, sustainability-linked bonds, in relation to key performance indicators and SPTs. And that's also been an important discussion for this market. If I think more broadly outside of what we're doing with the GBP, I mean, the other big topics that come to mind are, one, this focus on what's happening at the organization level in terms of sustainability information. We've been talking about ESG ratings. It's very important. And we're talking also about initiatives on sustainability standards. And it's going to be important for us in the sustainable market to think about how that feeds in or not to what we're doing. I mean, it's an organization level approach. We have use of proceeds, we have sustainability linked bonds, which link again to organization level. So that's going to be very interesting. The other key development that I wanted to talk about, of course, is regulation. We've heard from the Commission on the EU Green Bond Standard, and I was really delighted to hear the reaffirmation of the voluntary nature of the bond, and Alexandra's smiling at me. But we have to underline that, because there's been a very active debate in the Parliament saying that it should be mandatory. And there's also a very active debate in the Parliament saying that it shouldn't just concern green bonds, it should concern all sustainable bonds. Trilogue has started. We shouldn't over-anticipate. We're very active participants in the discussion. We're on the PSF. We'll be publishing next week, actually, and sharing our thoughts. But all this to say, we're completely aligned with Alexandra's comment on, let's keep it voluntary, let's keep it a gold standard. That's where we started. And then we can work together to see how regulation then evolves. And, we will be, hope to be a key stakeholder. The final thing I wanted to mention, and I wanted to make sure that we address this publicly, this debate about greenwashing. This is something which is very active in relation to the fund market, to asset management. Fingers crossed for the moment in the sustainable bond market, we don't seem to have the spotlight quite on us, but I think we shouldn't be complacent. We need to be worried about this, concerned about this. And if you think about how, greenwashing could potentially, how we can think about greenwashing in our market, I think the first thing is misrepresentation. And is this misrepresentation potentially fraud? That's the first thing. The second thing is it green enough? Is it sustainable enough? It's sort of the quality of what we're doing. And then the final one is what I refer to as tokenism, i.e., is an issuer actually committed to a trajectory, to an overall sustainability strategy, or is he just doing something discrete which doesn't actually engage the overall organization? I think those are the parameters that we should need to be thinking about. And as you can see, these are different situations, require different answers and of different levels of gravity. And so I think with the regulators, it would be good to have that debate and sort of making distinction, because one of the things that bothers me is we use greenwashing for all kinds of different situations. We're tarring every situation with the same brush. I think that's a bit dangerous. We need to be more specific. We need to be more informed. I've spoken too long.
No, you touched on some very key points. And the regulation part of things, I think, is pretty interesting in terms of when you think about the market as the investors being the carrot, essentially, the appetite and the pressure from investors. And then, of course, the regulator really is the stick at the end. So I think for issuers, the way that we are thinking about this market is incredibly important, that dichotomy, but also thinking about it as a convergence. And some of it is what Andrew alluded to. And I said Andrew was probably happy with the comments that Judy made, and we'll come back to that in a moment. But, Neil, Article 8, of course, of the EU taxonomy regulation introduced the green asset ratio, which, as you all may know, measures a bank's green assets as a share of its total assets. Now, Neil, what do you foresee as the strategic implication of this for banks?
Okay, maybe a word of introduction. By the way, Brussels is not just the capital of Belgium or Europe, it's also the capital of obscure financial lexicon. So maybe the term green asset ratio might need some explanation, but essentially the idea is that it's a requirement, a rule that will require all non-financial and financial institutions to disclose that part of the balance sheet that is purely fully taxonomy aligned, building on the taxonomy for climate change that has been developed by the EU institutions. And I think the logic is really to require banks to put this information into the marketplace to allow investors, issuers, and other stakeholders in the banks to assess the extent to which the balance sheets of the banks are properly shielded or to which extent the balance sheets are exposed to climate change stress. And that, I think, is the inherent logic. The banks will have until 2024 to prepare for the application for these disclosures. It is a disclosure-based approach, as with much of the EU regulation. The disclosure around taxonomy alignment does not in any way exclude disclosures about non-taxonomy aligned ESG investments, which is financial and non-financials can do on a voluntary basis. This taxonomy, or this disclosure requirement does not extend or does not encompass sovereign exposures, because sovereign exposures are difficult to work out precisely for programmatic, policy-driven expenditure by governments to apply the climate change metrics to, for example, education, training, upskilling, etc., as opposed to investment in intangible productive capacity. So that current inability to cater for public issuance, I think, is something that the framework, the policy framework, needs to address, given that public green bond issuance is going to be the mainstay of the market in the near future. In any event, we ourselves are working on the back of an ICMA-based green bond framework. So we have, as with SURE, built on the ICMA template, but we have baked into the cake a large degree of taxonomy alignment. 80% of the expenditures that we are financing through next generation EU issuance are fully taxonomy aligned, and 20% fall in this category of, yes, shares the same objective, but we cannot measure against the climate change metrics. And I think that's a challenge faced by many public policy authorities, agencies, etc. And I think the framework needs to provide solutions, the policy framework needs to provide solutions for this large part of the market. In the interim, the Commission is doing what we can best do here, which is provide full transparency about what we are funding. You can see on our website, line by line, the policies in member states that we are funding through our green bond issuance, and we allow investors to make their own judgment. And I think for the moment, we're very satisfied that investors are trusting us and giving us their confidence.
I want to stick with contemplating what the implications are of this beyond the financial sector, as it were, looking at the real economy. And perhaps I will take a view from Jerome. I mean, from your perspective, what is the insurance industry's role around, green investments? What's the impact on the real economy?
Well, thanks for that. So in terms of the question, what's the role of insurance industry in this green investment? I think it's crystal clear. It's a unique sector because the insurance sector is pricing the risk of natural catastrophes, provides insurance, reinsurance solutions. Second, by pricing it risk and taking the risk on its balance sheet, it's transforming the risk as well, and allows the real economy and financial markets to do the risk taking in the first place. And third, if you think about it, the insurance industry as a whole, we are long-term investors as well. And the fact is, the insurance industry provides about 30% of the $80 trillion under assets under management from the long-term investment space. And that's a lot of money, 30% of 80 trillion. And we want to invest it in, yes, in sustainable infrastructure. We want to invest in green investments. So we very much depend in having a taxonomy in place. We very much depend, we have the highways, right? We have built the highways, we have very modern financial markets, we have deep capital markets, deeper in the US than in Europe, but we are extremely well integrated global capital markets, but we don't really have the kind of the standards or the signals, right? At which, where can you go? What is the traffic speed? And we need that. And I think we need it not just in Europe, but we need to have a global gold standard, or at least kind of a minimum standard. But bottom line, from the insurance industry, I think a unique and very positive role, pricing, transferring and investing into green assets. And that's very much unique. Maybe one point, climate change, right? What does that mean, climate change, in terms of annual losses, economic losses for the society at large? And we provide the data on an annual basis. If you look at Swiss Re data, economic losses from natural catastrophes, for example, last year, there were $270 billion. These are the economic losses. And the fact is, if you look at the Nat Cat protection gap, so the protection gap, the part of it which is not insured from natural catastrophes, it is $161 billion, and 75% of natural catastrophes are not insured. So yes, we can also do much more in terms of the industry, in terms of providing the protection. But for that, again, we need to have transparency out there so that we can price and take the risks on the balance sheet, transform, and then last but not least, very importantly, also invest into assets. So quite a menu on that. I close now. Thank you.
I think of that as all the ingredients for the sustainable finance soup. So very well done on ticking all of those. And just still, I'll switch gears a bit. You know, we touched already on this emerging trend of essentially looking under the sheets at what lies beneath when evaluating issuers at an enterprise level, and looking at, you know, potentially common sustainability metrics. What role is ESG rating playing in this? Does it deter greenwashing? We talked about greenwashing earlier.
Well, yeah, I mean, I think there's a very nice and succinct categorization of three different levels of greenwashing from Nicholas.
Can be spontaneously.
Of course.
Right,
of course. And if I think, I mean, our role as an ESG ratings business, and that's sustainable Fitch as opposed to the credit ratings business, is to sort of provide an independent and objective view on ESG performance, impact, and outcomes. And those three factors that Nicholas talked about, if you're looking at fraud, it's pretty impossible to tell that you're suffering fraudulent activity until you discover it. So you're not going to predict fraud. However, the other two aspects that you talked about, if you can create an analysis framework that is transparent, it's granular, and it's cross-comparable, then you can overcome most of the other issues. Now, data will be an issue, but if you can identify the data that you've looked at, you can be very clear and transparent about what you've taken into account, and you can build a detailed framework that's capable of challenge, then you start to cut through the elements of greenwashing that have been mentioned. And we spent, before we launched Sustainable Fitch last year, we spent 2 years building an analysis framework for ESG performance, impact, and outcomes in conjunction with feedback from asset managers and asset owners to try and do precisely that, so that you could have a cross-comparable scale on an absolute basis, and you could look at ESG ratings for entities, but you can also look at ESG ratings for individual debt instruments. And those individual debt instruments, when you go into that level of detail, you can then create an analysis that shows you alignment with different standards. And the work that's been done by the ICMA, for instance, on the green bond standards, the leading work that the EU has done on green bond taxonomy, so the environmental aspects of that, all helped inform what we created as an analysis framework, but we're not pinned to that. We're looking at taxonomies of reference where we look at the absolute best threshold that is available. And at the moment, for green bonds, for sustainable ones, it's clearly into the ICMA for the taxonomy and the detail in terms of technical screening criteria, it's EU. And that sort of thing really helps, I think, with this transparency and comparable data. I mean, we mentioned very briefly green asset ratios as well, the EBA, the European Banking Authority, looking to start to impose that on banks as enablers of sustainable finance. And again, it's not a perfect solution, but perfect can be the enemy of good. And we talked and we heard earlier in the conference about progress and the time that we have left to tackle climate change. And whilst it may not be perfect, it starts that journey. It forces some more of that comparable disclosure. There will be problems. There'll be issues with estimations. There'll be issues with inability to get data from entities disclosing. But what it does is it forces an entire area of the market to start to look at portfolio, and people start to look at flow, and they start to look at the amount of funding that is being directed towards, and that's the most important part of the green asset ratio, we think, in the short term, is flow. I can talk extensively and I won't, because we have a time limit. If you like more detail on this stuff, take a look on our website. We produce thematic research on everything from Chinese green bond standards and Chinese taxonomy through to views on the SEC and the implications of SEC disclosures, right through to a very detailed report on the green asset ratio implications, the good and the bad of that.
Thank you. May I take this opportunity to remind everyone that if you have questions, to go ahead and send them, and we will take questions at the end. There's this running thread of transparency, and then there's the other of essentially looking at an issuer beyond the label at the corporate strategy. And Julia talked about, climate-aligned issuance of 75%. Andrew had a smirk on his face, which I think meant he was happy. But Andrew, how do you as an issuer then treat ESG ratings? And are you finding investors are increasingly using these to make investment decisions? You'd mentioned that, I think what it sounded like was your wish is for the market to see you as sustainable, because you're already green asset ratio compliant, it sounds like. Tell us more.
So I have a few thoughts on this topic. So we, like many other supranationals, have unsolicited ratings, unsolicited ESG ratings, and then I see old friends from EBRD and EIB in the room. We have AAA ratings from Fitch, Moody's, and S&P. On the unsolicited ratings, where we're approached, we send a lot of information across. And I remember, and I see that as positively disruptive to that environment, right? The more participants, different ways of thinking, different methodologies, it's all really constructive. And I remember looking at one of the ratings, which was around diversity. And I looked at our score, and I was looking at the other Supras. And it's fair to say that I thought we all had pretty ordinary scores when it came to the evaluation on diversity. And so I dug into it, and I phoned the analyst up and said, what's the story? And so they were looking at our board. So AIB has 105 shareholders. The shareholders decide who's going to be on our board. And I'm sure it's pretty similar for maybe New Development Bank, for EIB, for EBRD. I've got three friends in the room, so I want to identify those three friends. And the issue with that was the management team has no ability to change that, to influence that. So I remember going to the board, and I used it as an opportunity. I said, look, we have these pretty ordinary ratings. I can't change them. It's actually on you. I mean, I think I did it a little bit more politely than that, but that's pretty much what I said. If I look at the ESG ratings component of Fitch, Moody's, and S&P, I grew up understanding the methodology around supranationals. And then each of the rating agencies sort of did a review a few years ago with some learnings. And, you know, well tested, you understood it, loss given defaults, probabilities, preferred creditor status, equity, pretty analytical. And, you know, World Bank's been around for 80 years, so you could say 80 years of good statistical history. And then I started poking around in the ESG component. And I found, you know, the rating agencies will say, I'm going to put words into Andrew's mouth because it's a bit more entertaining that way, that they had always done or always included some portion within their ratings. It may not have been absolutely clear. And so I've recently started sweating that component of our ratings, trying to understand. It intuitively, to me, feels a bit more qualitative than quantitative. I mean, Andrew can dispute it, and he probably should, but as I sort of understand it, if we're arguing over standards, we're arguing over conformity, we're arguing over adoption, that rating becomes pretty important. The last point, just to challenge the audience a little bit. So I have seen us do bond issues. I've seen the IFC do bond issues. And I remember a phone call once from a pretty sizable asset manager, portfolio manager. And the PM said, looking at your issue, is it classified as a green bond? No, no digging into the prospectus or the shelf, no digging into the disclosure. And that's almost the worst thing for us to do because we just love to share, right? But it was just, does it tick the box? And I think that's quite dangerous because in the concept of greenwashing and such, you're assuming an educated, informed purchasing decision. But if you're sort of outsourcing that to what box gets ticked on Bloomberg, it does seem to change the dynamic a little bit.
It does depend. I mean, I would say that, of course, more sophisticated investors would do their analysis beyond the label. But there is a lot of reliance on that label and the infrastructure, the stock exchanges, the indices, etc., to ensure that alignment to, well, what is, of course, right now the world's most referenced framework, which is the Green Bond Principles. Andrew, still, it seems like you have a response.
I've got to be tempted to make a comment or two in response to the other Andrew's comments. And, you know, there's a lot that you said, actually, I don't disagree with. But the important thing is you've got to, when you're looking at whether it's credit ratings or ESG ratings, you've got to really understand what it is that you're looking at. And from a credit ratings perspective, the credit ratings look at financial materiality. And this is a debate we've had with regulators on the credit rating side for several years now. And the importance there is from an investor perspective, they want to know if it's financially material. And so you talk about looking back through what's been done, but the hard and fast fact of that is most of the environmental and social factors are not financially material to credit ratings. Governance tends to be far more material. And actually, if you look at things like the SSAs, and if you look at the World Bank, if you look at the ESG analysis we do within our credit ratings for something like the World Bank, you'll see that independence and governance get slammed because of the influence of the US on the World Bank. And so we apply that equally, whether it's, and we had long debates about this because initially, of course, the analysts were saying, oh, China and emerging markets, we need to bash those. And we turned around and said, well, also, you know, World Bank and US, it's exactly the same. It's no different. Just because it happens to be a different country, in terms of the factor that you're looking at, it's the same. But again, it's financial materiality. So it's important to separate financial materiality from ESG performance
I just want to say that, I mean, I think everyone here is well aware of the headlines around the matter of materiality coming from Mr. Kirk's comments at the FT Tomorrow Morning Summit. So perhaps we don't want to spend too much time on this debate here as to whether ESG is material or not to financial decisions. You know, I think what is interesting is just to wrap up on the ESG ratings, because I think that's a whole different panel on its own, is there are, of course, certain issues we're all aware of. The MIT did this confusion project, which is very interesting to read if you are keen on it. there are issues. The correlation, you know, when you look at it across the rating agencies is just something to behold. Nevertheless, it is playing a role. And I think that what we're, you know, on this debate essentially is to what are the alternatives that investors have beyond labels. I want to come to this critical question as to what is the future of these bonds. You know, I guess Andrew's point was, if I understood you correctly, that there is no point to having it because you're saying you do not think it is the right approach. You see it as a checkbox exercise. I don't necessarily take that view. But Julie and Nicholas, I want to hear from you both. Do you think investors can take an entity level approach with these bonds? I mean, is that the future?
Well, I am personally convinced of that indeed. I think that especially dark green investors now not happy enough with investing in a green side project, and especially where they do not understand or where they do not see any correlation between the funding strategy and the overall strategy of the issuer. And this is really something very important. And I would say more and beyond ESG ratings that I'm not going to comment this, except to say that I think we really need transparency on the methodologies that are used and on the weights that are posed on the different credentials, being social governance versus environmental credential, which could lead really to very different rating, which might be confusing for investors. And as a market infrastructure, our role is a mission is to protect investors. So to make sure that they have enough transparent information they can understand to make informed investment decision. But to come back to the evolution of green social and sustainability bond, where we were looking so far only at the product as a use of proceeds. Indeed, I think since 2020 and this transition decade, we're looking also at the entity level and the overall strategy of the
You mean in the climate aligned segment you spoke about earlier?
In particular,
okay.
but not only. And I'm convinced as well that if we see the EU GBS requesting also the disclosure of a transition plan at the issuer level, then this might also lead the market to any type of issuer should at the end disclose such transition plan, and not only green, social and sustainability bond. And then we will see again the advantage of green, social and sustainability bond, because they would disclose at the double level of the entity and the product level.
No, indeed. Nicholas, are you contrarian or?
Well, I'd like to start with a bit of history. I mean, what's interesting about this debate is the way this market started, you know, casting our minds back, you know, 5-7 years, it was called the use of proceeds market. And the whole point was you weren't looking at the issuer. That was the idea. And I remember we were having these conversations. The great thing about the green bond market is you can take a brown issuer, and if he's doing a green project, you can finance that green project. And that was the whole point. It was to be able to draw in holistically as many issues as possible, as long as what they did was green. That was the point, okay? So from there, we got into trouble. We got into trouble because people say, well, wait a minute, I'm not that excited about owning a bond which might be green, but the issue is brown, because I want to know if the issue is going to stay brown. So quite logically, then we started saying, well, the issue's got to show us a trajectory and has to have a credible strategy. And our guidance changed over the years. I mean, that's clear in the GBP now. That's what we say. So, you know, you've got to show this, okay? But it's important to have that in mind. So coming to today, having this additional information at the issuer level, I think is very useful, right? It feeds in, it allows us to answer that question. Now, we have a new product, which, you know, we mentioned earlier, the sustainability linked bond, and this is where we completely reversed our logic, and we said, let's stop looking at the project, let's look at the entity, let's actually target the entity, let's have metrics, let's have KPIs, and in that respect, it's really interesting. I mean, can we use ratings in that? You know, I have a question mark, because if we disagree on the methodology, I'm not sure we can use those ratings. And there have been examples in the market of trying to use the rating, but that's a big question mark, I think. Now, when you talk about other approaches, you know, sustainability standards or the taxonomy, again, can we use these? Let's see. I mean, you know, time will tell. The final point, though, is, you know, I mentioned earlier that we're expanding our advice to other markets, particularly the short end of the curve. And this issue of, can I say I'm sustainable if I'm in a short-term market, if my counterparty is sustainable? You know, Is that one way of saying that I'm being green because I'm selecting my counterparties? Well, that's really interesting, and it brings us back particularly to ESG ratings. And again, that's a tricky one because we haven't agreed. We don't have a concept yet. Now, you can look at it differently. You could say, well, if my issuer is 80% taxonomy aligned, in its economic activities, does that mean it's okay? I think that's going to keep us busy. By the way, I don't think that many people can be 80% taxonomy aligned, but that's, I saw you reacting there. But anyway, this is all sort of speculation. It's going to keep us busy.
But I think there's one aspect to that that brings us back full circle to the point that Andrew was making earlier as well, is that if you have enough detail and transparency, then you can look at a conventional bond from a pure player, and you can compare that directly with a sustainability-linked bond. And if that same player is issuing a KPI-linked bond where the KPIs are exactly the same as their corporate KPIs because everything they do is linked to ENS factors, then the ESG rating for those should be identical. And that was the principle that we started off at when we designed our analysis framework that we're putting out into the market now. Is the future of all of this is investors won't really care whether it's labeled or not. It may be useful for purposes for issuers to demonstrate stuff, but in the future, they'll just want to know the ESG characteristics of whatever they're investing in, whether it's a conventional bond, whether it's a labeled bond.
Yeah, well, the complexity of that is enormous.
It's huge. It is huge.
So I mean, I don't see that happening tomorrow, and I don't have any views on that. But we do spend a lot of time, particularly talking about the environmental part of finance. And I want to hear from Niall and Jerome. How can we replicate the progress seen on the E and extend it to S and G?
Yeah. Well, again, I approach this from an issuer perspective, reflecting an institution that whose first and foremost objective is funding a climate transition. But therefore, I think our preoccupation and our deliberate choice and strategy is to privilege green bond issuance, and I think that's very much aligned also with the market trends that we see, where green issuance by a wide range of issuers, but the demand is far outstripping that supply at the moment. I think it's natural, faced with this existential challenge, people are looking for investments that will contribute to providing solutions. And we have made that choice, next generation EU green bond, and we are not going to dilute that by trying to issue alongside it social or anything else. That doesn't mean there is no space for social in the marketplace. On the contrary, I think we benefited from that social framework in the past when we came to market first with SURE. For issuers with a strong social public ethos and a societal impact that they can track. In our case, it was support for jobs during the lockdown. Where the SURE loans helped sustain over 3.25 million jobs across the beneficiary member states. It was easy to do, and it's a powerful thing, and it allows you to kind of put yourself out in the market and facilitate funding solutions. So I think social, there's definitely plenty of space for a vibrant social market there. Governance, I think it brings us really into this territory of institutional level assessment. I think also good governance is in the eye of the beholder, a lot of subjectivity there. And we know about bad governance only when there's a scandal and misbehavior. So I think it is quite complex to try to capture that with the same type of analytical rigor that we are bringing to green and social as well. But as an issuer, I'm going to be focused on what my objective is, and what I can deliver and bring value to the market. And just to conclude, as an issuer, I think the market can use labels. The market can rely on them. It's a shortcut for investors, but it's a shortcut that works because the issuer cannot afford the reputational risk of misrepresentation or greenwashing that Nicholas referred to earlier. There's just no way that we can countenance that. So I think the market can build a lot of confidence on the fact that investors, or sorry, that issuers will invest in really kicking the tires on their frameworks, be it green, be it social.
Before we come to you, Jerome, I want to check to see if there are any audience questions. Okay, well, Jerome.
All right. Well, the question was, how do we get to, how can we progress on the S and the G
Indeed.
and do what we have been doing on the E? I think about August 15, 1971. August 15, 1971, what happened? Nixon announced in TV program in the US to the public, that's the end of the gold standard. Dollar won't be fixed anymore against the gold. Now we have spoken a lot about gold standard in this panel and in the whole day. We are in the search of a gold standard, and we are in the search of a gold standard for the E. But if you're in the search of a gold standard for the E, S, and G, the task will be just so much bigger, which brings me back, I think, to the search of a new system. We need a Bretton Woods #3 for sustainable finance. I think that's what we really need. Now, today, the ECB has announced its hiking path on 2022. Luckily, it might be the year with negative yields. Could be history, or at least we are in the path that will be history, if not 2022, 2023. And I think we need to make sure that we use this environment where we have higher rates and where risk-free rates provide some return again, that we build a system which serves the economy, which improves economic trend growth. And that's why I'm very thankful to the work of ICMA, right? And in terms of the principles that work that you have been doing on the green bonds, that you're doing on the social bonds, and we need to progress. The market will progress, there's no doubt about that, but we also need to have policymakers getting together. That's why I say we need a Bretton Woods #3, and it's time to act. August 15, 1971, 51 years ago. Now we are finally ending negative rates environment. That experiment is not a good one. Let's make sure that the next decade or decades will be better. Thank you.
I love that. So let's stay on the date. So I'm going to ask Julie, it is New Year's Eve, 2029. What is your wish to the Sustainable Finance Fairy?
My wish is that we will no longer be speaking about sustainable finance.
Okay.
What did you say?
Andrew Cross.
Oh. So in rehearsing for this one, I obviously had, as the team told me, an incorrectly flippant answer, so I can't use that one. So, so I worked in sub-Saharan Africa for a while, and if you look at the countries in sub-Saharan Africa, and particularly in North Africa, who have an abundance of sunshine. I'm going to skew your question a bit, Denise, but let me do it anyway. What would be amazing is if we live in a world where those countries which have an abundance of sunshine are rich and prosperous. And so if you think through that, what that means in terms of technology, transmission, exporting electricity, batteries, that's a pretty phenomenal world.
Very positive note to end the panel. I want to take the time to thank you all very, very much for your insight, and thank you also to the audience.